Let's bring in our halftime headliner today, Brian Belski of BMO, who makes the argument, interestingly, and maybe not that interesting, because you have gone against the crowd for the better part of the last 18 months, and sometimes, frankly, at your peril, which you have admitted on this program. But you suggest you want to buy the dip in financials. Why?
Good afternoon, Scott. Thanks for mentioning that. You know, money is made when there's blood in the streets. I'm not saying that there's blood in the streets in financials, but we need to take 2 steps back and, number 1, apply some common sense. Number 2, apply some analysis. And number 3, kind of look at things longer term. So let's look at the common sense side of things. I think the market's throwing the baby out with the bathwater with all these financials, and they're not treating all financials equally. And what we think is going to end up happening from a thematic basis and strategically are 3 things. Number 1, the inverse of what happened post the great financial crisis, where small and medium banks were the really things to be, and everyone shunned the big banks. I think it's pretty clear that big money center banks and Canadian banks are going to be the big winners in this as investors. Now, whether or not you're a private client investor, a commercial real estate investor, or an institutional investor, are going to go to the big banks where the balance sheets and the stabilities are. That's kind of number 1 thing. Number 2 theme is that because of the issues in the small mid banks, I think they're going to see massive consolidation. And number 3, with respect to going forward in regulation, I think there's going to be pointed regulation toward the small and mid banks. From a fundamental perspective, Tier 1 capital ratios are 400 basis points above where we were in the great financial crisis. Loan to deposit ratios are very steady. Held to maturity securities are very pointed in those banks that were the bad behavior banks. We're seeing no systemic risk, but the financials at 14% of the market, we believe would be a strong overweight here and propose a great value at these levels. You don't have to own them all, Scott. You have to be very select. And from our work with rising dispersion and rising earnings growth dispersion across the market, but especially on a sector level, you absolutely positively have to be a stock picker.
But I feel like, you're in the Mike Mayo camp of, as you look at bank to bank, that in his words, as he puts it, Goliath is winning. I just feel like even so, that may be the case. But after SVB and what's happened with regional banks and how some of credit may be changing, that Goliath is getting hit with more stones than we otherwise originally thought.
Well, I don't necessarily agree with that, Scott, because, again, this is about stock picking. And I think we in the investment community, frankly, have gotten lazy by just buying ETFs or being broader on the market. That's why you have to roll up your sleeves and do individual work on some of these banks. Like, for instance, in the small mid-cap portfolio, we own Glacier Bank and First Citizen. These are banks that have great management teams, very clean balance sheets, very clean loan portfolios, and unfortunately, you have to kind of sift through the rubble to find those big names, or the best names, In the big cap banks, Mr. Moynihan and Mr. Diamond set the stage when they talked about fourth quarter earnings and 2023 earnings early in January, where they started this mantra of under-promise and over-deliver. In Mr. Diamond's letter that everybody wants to talk about this week only accentuated that. And, oh, by the way, he said, maybe not things are so bad. But so that's why you want to be more concentrated with respect to your holdings, maintain that overweight, let everybody be bearish. If you look at our fund flow chart that we put in our report today, everyone and their mother, brother, sister, cousin, uncles chasing utilities. We'd say good luck with that. Same thing on the staple side. They're expensive. You want to look at where people are not. You want to always want to skate to where the puck is going, Scott. Yeah, and where the puck is going is these areas.
If the puck is going to a softer portion of the ice because the economy is obviously weakening by virtue of the data, do you really want to skate there at the risk of falling through?
Yes, I do, because remember, stocks lead earnings, which lead the economy. The stock market, if and when we see the softness in the economy, Scott, the Fed's going to cut rates. Karen was amazing when she talked about, and Bryn talked about the Fed's going to be late. Everybody knows the Fed's going to be late. The Fed's going to overshoot. We know that. Scott, what's the market going to do if and when the Fed cuts rates? Come on. we're not in a period where we're going back to zero interest rates anytime soon. Joe talks about disinflation. You have disinflation, yeah, from the medium banks, but you also have disinflation from the growth aspects of the market, which would be technology. The market's going to rally the second half of the year. To be talking about the market peaking in the first quarter makes no sense. Are we going to be choppy here?
What if we're in a